Imagine you own a 10-story office tower in Miami. You've had it for 12 years. It cash flows, the tenants are solid, the debt is manageable. Then, one morning, your insurance broker calls and says, "We can't renew your policy. Nobody will cover this building. What do you do?" Here's what's happening. After years of brutal hurricane seasons, catastrophic wildfires, and billion-dollar hail events, insurance carriers are pulling back from the riskiest commercial real estate markets in America. And it's not subtle. In coastal Florida, premiums on commercial properties have jumped 25 to 50% in a single renewal cycle. Parts of California's wildfire interface? Same story. The Texas hail corridor from Dallas to San Antonio? Carriers are either repricing aggressively or walking away entirely. Meanwhile, and this is the twist, the overall national market is actually softening. Rates dropped about 4% in late 2025. Carriers are competing for business in low-risk markets, so we have two completely different realities depending on where your building sits on a map. To understand why this matters, you need to see how insurance fits into the financial stack of a commercial building. At the bottom, you've got your physical asset. Above that, your revenue. Rents from tenants, then operating expenses, then debt service on your mortgage. Insurance sits right on top. Now here's the thing. When insurance was 2% of your operating budget, nobody thought about it. It was a line item. But when it jumps to 8, 10, 12% of your operating costs, it compresses everything below it. Your net operating income shrinks, which means your property is worth less, which means your loan-to-value ratio is suddenly out of whack, which means your lender starts making phone calls. Let me show you the numbers. If you index insurance cost growth to the national average, call it 1x, here's what different markets look like. Miami is running at roughly 4.2 times the national average for premium growth. Houston, 3.1x, Los Angeles, 2.8, Dallas, 2.4. Now look at the other end. Phoenix, 1.6, Denver, 0.9. Actually below the national average. Nashville, 0.85. The spread between the most expensive and cheapest insurance markets in commercial real estate has never been wider. What makes this a crisis, and not just a cost problem, is the domino effect. When insurance premiums spike, property appraisals drops thus because net income is lower. When appraisals drop, lenders get nervous. They tighten terms, reduce proceeds, or refuse to refinance. When financing disappears, deals collapse. Buildings that were supposed to trade just don't. That creates a vacancy spiral in the worst hit markets. And here's the cruel irony. The tenants who stay, their rents go up because the landlord is passing through insurance costs. So the buildings that can least afford to lose tenants are the ones charging more. So where is the money going? Institutional capital is following the insurance math. Markets like Nashville, the Carolinas, Denver, and parts of the Midwest are seeing increased allocations specifically because their insurance profiles are favorable. It's not just about cheaper premiums. It's about predictability. Investors can model a Nashville deal with confidence that insurance won't blow up their returns in year 3. You can't say that about a coastal Florida asset right now. Some funds are explicitly adding climate risk to their underwriting models for the first time, and the data is starting to show up in transaction volume. Inland secondary markets are seeing deal flow increase while coastal primary markets are slowing. Whether you're an investor, a developer, a tenant, or just someone who pays rent, this insurance bifurcation is reshaping American commercial real estate in ways that will play out for decades. The cities that solve their insurability problem will attract capital. The ones that don't will watch it leave. And for the first time in modern CRE history, the most important question about a building isn't its cap rate or its vacancy, it's whether anyone will insure it. That's the new map of commercial real estate, and it's being redrawn right now